Good morning, everybody, and welcome to another Friday Mastermind. It's always awesome when we bring in Dan Rawitch and hear about what's happening in the market. Hopefully, we'll get some predictions on what's going to happen with rates. Dan always, like literally 100% of the time in his daily updates, gives value. Helps give you talking points, gives you value, helps you understand what's happening in the market, how that is going to impact housing going forward. Also, he always gives you value that you can bring to your realtors. And usually he's right about what's happening with interest rates more than most. So Todd, anything you want to say before we kick off today's call with Dan?
I'm just excited. We're wrapping up the year. You've got me lined up as the guest on Tuesday, so I'd love you all to show up. I'm going to talk about the 3 ways that you can launch into 2024 with the highest probability of success. And would love to have a bunch of you there and share some great ideas. And as always, I'm here alongside of all of you learning from Dan, because Dan is my guru when it comes to all things about money.
Oh, thank you.
Yeah, but by the way, that's a pretty killer headline. The 3 things you can do to have the highest probability of success. I didn't know that was the
pretty
headline.
good, huh?
I like
that was pretty good.
That's a really good headline.
I got here, and I didn't even have Deborah Bird help me with that. But all things social media is my good friend Deborah Bird. What's up, Deborah?
Hello, happy Friday. It's officially halfway through the month, guys, December 15th. So, and some good news with rates this week. So I'm excited for this call. And I know there's a lot of loan officers that are also going to be taking notes. So thank you, Dan, for allowing us to be smarter and wiser, sharing your wisdom.
Thank you, Deb.
Yeah, and let's face it, guys, it's not really halfway through the month, because what really gets done the week between Christmas and Thanksgiving. So like there is a week left of hard charging, and hopefully you will show up next week for what we're doing. I don't know if we're going to do the Tuesday, the day after Christmas, or the Friday, before New Year's. If you really want us to do it, let me know. If you have topics, or like, Dave, we want to do that Tuesday after Christmas. Let me know what the topic would be. Let me know you want it, and let me know what the topic is. And if no one tells me they want it, no one gives me a topic, we'll probably cancel it. So with that said, let's bring Dan Rawitch on stage. Dan, again, I trust you to deliver this however you want, but I'm currently reviewing the top 10 videos of in YouTube from last year, and 5 of them had the word realtor in them. So out of the top 10, 5 of them had something to do with how to be successful with real estate agents. So just kind of keep that in mind as you give this update. It's going to help us understand the markets, be better loan officers. But if there is something that, like, hey, this would be a good slide for a lunch and learn with a realtor, or Deborah Bird, if you're like, oh, this would help you bring more value to realtors, let's just be cognizant that that is what our community, is attracted to right now. So
Awesome.
Dan.
So Dave, I don't know if this is anything you can do in this large format, but I started using Fathom, which is part of Zoom, and it takes great notes, and it would literally, you'll know what slide I'm talking about, and it would help you deliver the presentation, because you'll see my talking points. But I don't know if you guys can get to that, or if you can record what I'm saying on Zoom on your own screen. Sorry, not Zoom, but Loom, because Loom also has the AI that gives you a transcript of what I'm talking about. Because people are telling me that to be able to say, okay, slide number 5, he said this. Because sorry, Dave.
No, go ahead. Oh, finish your sentence. I didn't mean to cut you off.
The idea is there's no reason you can't give this to realtors. And to the extent that you're probably interested, not trying to flatter myself, but you want to know what's coming, you want to know what to expect, so do your agents. So it's a really easy way to get an interested group together, if you can just give this presentation, and I don't think it's that difficult.
Yeah,
that's it.
Real quick on that. And that's a really good takeaway. Everybody, let's upgrade our note taking. And there are a number of AI tools that are doing it. And and I'm even seeing that in some of the content I'm creating. I'm seeing all these different AI Joe and AI Bob. And so I'll put some best practices together. We're actually doing some research right now internally because I use Otter, so like I literally have Otter going right now on my phone, and then we use Zoom and we use some of the AI on it, but I don't think I use that. And community, if you have any best practices on that you want to share in comments down below, let's as a community get better at taking notes so that we can take all the content we're creating and put it into action better. So I love that, Dan. Thank you.
Can I throw one thing in real quick? What I find is when I use Otter, when I'm at like a seminar or on a call like this, it allows me to be more present because I'm not trying to feverishly scribble notes that I can't read later. And so it gives you an opportunity just to put a couple of quick highlights of what you want and then note the time that it was so you can go back into whatever AI you use to record it. So just be thinking about how you can be more efficient and more present and actually get more out of today.
Yeah, I discovered Fathom through coach that I use. And after the session, he would send me the notes. And I was like, I didn't even see him taking notes. But they're perfect because it's like minute 3, we agreed on this. And the AI just does all that. So that's Fathom, and it's part of Zoom. If you guys want to look into that. And I think it's free.
Wow.
Okay, ready? Okay, so you can see my PowerPoint.
Yeah, they actually came out perfect now. Last time they were a little squishy, so it's better.
Yeah, I'm not doing the presentation mode because that like tries to put it on this 53-inch screen and nothing works. So you'll have to bear with it not being in presentation.
No, it's nice. This is perfect. And Dan, are you gonna share the slides like you usually do?
Of course.
So guys, they'll be in 2 places. One in our Facebook group, Trust Engine Productivity. There'll be a download. So like the files that you could download there. And then if you're watching this in YouTube, there'll be a link to these in Google Docs. So we'll have a couple different ways for you to get to these. So cool. Thank you, Dan.
Beautiful. So just to frame this real quickly, the last presentation I gave, Dave was more intentional than usual in a good way to pin me down to a prediction. And I liked the way he did it. He kept saying, no, tell me again, what are you saying? So I'm going to tell you what I said. I said that sometime in the 4th or 1st quarter between, mid 4th to late 1st, we should see some very big things happening with interest rates. So, and I do believe we're starting to see that unfold. I think the Fed kind of opened up that window. Not saying that they're gonna just go straight down from here, but I do believe we've begun the path. So there's kind of your spoiler, and now let me back it up with some data.
Love it.
This funny looking chart, if you look down here, every one of these are different yield curves. So I real quickly, I'm just going to talk about yield curves because if you haven't talked to me before, you may not know what they are. Not everybody does. So if you think about the 1-year treasury, the rate's usually going to be whatever. Let's just say 1% for fun. And the 5-year treasury historically might then be 1.5. And the 10-year might be 2. And you get this really nice slope, right? From short-term to long-term rates, because that's how they work. Short-term is low, long-term are higher. Makes sense. Investors are going to commit their money for longer periods. However, when things get wonky, those curves, that curve inverts. And that's really weird when you think about it. So the 1-year rate is higher than the 10-year. Think about that. So what's making that happen? And what's making that happen is investors are beginning to believe, the longer term investors, that rates are going to fall. And they think that they haven't fallen yet. The shorter term rates they think are going to fall as well. And so they're trying to lock in these higher rates. And it's kind of creating this inverted yield curve. And what an inverted yield curve has always told us every time is that there's a recession coming. So this is every yield curve tracked. So you have the 3-year against the 3-month, the 10-year against the 3-month, et cetera. So these are all different curves. Every single one of them are inverted. That hasn't happened. I don't know. I'm sure it's happened before, but I have never seen every curve invert. And if you think about it, just if one curve's inverted, like the 2 and the 10, we've gotten a recession 100% of the time. So now we have like whatever that is, 9, 12 different curves inverted. It tells a pretty powerful story. Whoops, I got to do it this way. Okay, so this is just kind of another look at the same thing. It's showing the percent of the 10 yield curves inverted. So each one of these things are inverted, and the blue is when there are recessions. So curve inverts, recession, 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 recession. It happens every time. Okay. So are we really going to have a recession? That's really the big question. The Fed wants to believe in the soft landing, and a soft landing means no recession, or you won't even feel it. It's going to be fine. Maybe he's right. But if he doesn't do something fast, it's impossible for him to be right. I don't know that he can save it anyway. And by the way, when I talk about recession, I know historically that sounds a little bit doomsday-ish. In our industry, it hasn't been doomsday-ish probably ever. Why? Because recession means unbelievably low rates. Everybody starts refinancing. The cash out refis start coming out of the woodwork. Rates are dropping. All the borrowers on the sidelines are going to go in. So I've always said we're kind of the morticians of the economy. We benefit from bad times. And I don't think it's going to be a terrible time. And I think that housing will completely transcend this recession. And I said that last time, and it did. So you can see it, how there's too much pent-up demand for housing. This is the economic composite index. So this red guy is a combination of many indicators. I think there's 8 or 9 different indicators in that. And you can see they've all really come crashing down. And if you look at this level, it's very close to 0. And you kind of scroll across here, you'll see that it doesn't get this low very often. And when it has, we've kind of seen some pretty bad recessions. So one of the reasons that things are continuing to cruise along, the Fed tells a story about tightening and trying to slow things down and inflation fears. And I suppose from the Fed standpoint, he's not causing what I'm showing you here. This is try to avoid politics. You guys know I don't like to talk about politics. But there's some political undertone here, i.e. the stimulus packages, the Inflation Reduction Act, the CHIPS Act. All of that is continuing to put money into the economy. And we're not really going to see the full benefit of the recession until this stops. And this really does have to stop. It cannot continue. So M2, we talk about that. M2 is the total value of all the money in circulation. So checking account, savings account, money markets, et cetera. And this is what happened to M2 during COVID. It reached historic levels. This goes back to 59. Hey, 1 year after I was born. So you're seeing my whole lifetime here in M2. And it's got insane. The money supply went up because the government directly put money into people's accounts. One area where I want to say I got it wrong, but I kind of didn't. That is, I said over the years that an increasing money supply in itself will not cause inflation, because it hasn't. But an increasing money supply, when you put the money right in people's pockets and the money goes into circulation, because when you talk about M2, you also have to talk about velocity. How much is that money moving? And historically, the higher the money supply went, the lower the velocity went. This time, velocity went through the roof, because again, it's the first time in a long, long time we literally put money in people's pockets, and they couldn't shop. This money was burning a hole in their pocket, and then even when they did want to shop, they couldn't buy anything because everything was kind of backlogged. Ships were backlogged. You know the story. The economy was absolutely frozen and people's pockets were flooded with money. The definition of inflation, again, is too much money chasing too few goods. Well, that's exactly what we did. We gave people too much money and then we created too few goods. I mean, how is that not going to be inflationary? So the supply chain is righting itself. It's pretty much back to normal, as is inflation, which I'll show you in a second here. This is GDP, the quarterly change at an annual rate. This is real, adjusted for inflation. And you can see it's not very pretty. It's not horrible, but look where it's come from. So we did get this little upturn. Again, I credit this little upturn to some of the stimulus the government's been putting into the economy. The consumer, they just keep spending. It's unbelievable. And this shows you from the University of Michigan Consumer Sentiment, and then there's Goldman Sachs Twitter Economic Sentiment. Consumer sentiment has been on the rise. And this obviously needs to calm down, or again, we won't see that recession. By the way, I don't think we need to see a recession to see these rates continue to fall. I'm very, very confident of that. So this is the Fed. What's next? Recession is not an option. He's signaling cuts, is about him forecasting a downturn. So I don't think he actually said that in his last Fed speech, which was what, Wednesday? But he's worried about this. And the first sign of weak data, this is historic fact, such as maybe a drop in payrolls, the Fed will start cutting like a mad person. So I think that's a really important point. The Fed does not want to see a downturn. He doesn't want that egg on his face. So again, when he sees a little bit of a hint of it, he's going to continue to push the rates down. And he sort of pushed them down by his comments. And I think those were very deliberate. This is just a phenomenon. It's unlike anything I've ever seen. We literally have the tightest housing market in history. The tightest. There's no inventory, which is helping, but at the same time, people are willing to pay higher prices, even with higher interest rates. So think about this when we come out of this really inflationary period and rates start dropping. Hopefully, we'll start seeing some inventory. I believe that these low rates, I think it's probably an obvious statement, have locked homeowners into their homes. And that's why the inventory thing keeps getting worse. Why would you sell a 3% rate when you have to go buy a 7% rate? You're going to wait until you can get a rate that you're okay with before you sell your home. So we kind of have these golden handcuffs on virtually every homeowner in America.
Hey, Dan, could you go back to that slide? I interviewed Brian Hale yesterday, and I don't know, I can't remember what the title of it was, but we were just talking about the markets and everything. And his opinion was that right when we get into the fives, like 5, not 5.9, 5.875, anything with a 5 on the front of it, and it will start moving the needle on the home buying market. Do you agree that it's going to take something that starts with a 5 to really change the story from an inventory perspective?
I think 5 is a really good psychological number. I think we're going to see that. I do very strongly believe we're going to see that in the next 30 to 60 days.
Fives?
Mm-hmm.
You think rates are going to go down that fast?
Yep. And I'll show you why. And there'll be a slide later.
All right.
Get back where I am.
Hey, Deborah,
I think that deserves some hand claps.
I see the look on your face. Hey guys, let's see a little emoji. How much would everybody like it if that happened? Wherever you're at right now, give this a like, give this a love. Would you like to see rates go down to 5 that fast? All right, Dan. Yeah, everybody wants that.
Let's stick with my end of first quarter. Okay, got a little aggressive in my statement. Which could be down
Oh,
in
he's
like,
backtracking now. All right,
yeah.
all right.
I've
Let's
always
keep
said by
going.
the end of the first quarter.
Spoken
I
like
do
a true
believe it's gonna,
economist.
I believe it's gonna come sooner.
Yeah.
So this has been a very long, painful upward trend on the 10-year bond going back to, first quarter of 20 and continuing, fourth quarter of 20. Yeah, sorry. Call it first quarter of 21. And you can see this path up, and trend lines are interesting and they're very dependable. We use them all the time in our trading program. So there's two things. This so far, every time we've touched this line, every single time we've recoiled and gone back up. This little green line is the 200-day moving average, which also acts like a trend line. And it's most traders, I would say, would agree with this. We look at the 200-day moving average as the long-term trend in the market. So we'll use like the 50-day moving average. So all this line is an average of the last 200 days. And traders will believe above it, you're in a strong trend. Below it, you're in a weakening trend. So we just broke it. We literally just broke not only just the long-term trend line, but we broke the 200. And I'll show you some areas where that's happened in the past. It could create what I said. Now you could look here and you say, well, we did break the 200 in early 23, but we did not break the trend line. This time, both are broken.
Hey, real quick, I want to insert two things. One, David Allen just mentioned that Dan on his webinar said that the 10-year would be in the threes at this time. So here we are, and he said Dan's the man. Deborah, if you could start thinking, like when we close this out at the end of this thing, what are some headlines? Like, if first of all, we have one of the industry's top forecasters of interest rates, Dan Rawitch, saying that rates are going to be in the fives by Q1. So that's, by the way, that's news. That's news that Dan said that. I see us all kind of like bragging about like other economists outside of our industry. Guys, Dan is right more than all of those guys. Like he knows interest rates and mortgage better than anyone. So there's a headline. Now, Deborah, as a social media leader, I want you to like, how should that be news? And should we be talking about that in the marketplace? So just be prepared to give some marketing advice and closing thoughts if you don't mind. And some headlines if you can think of any. All right, Dan.
Okay.
Sorry to interrupt you. I just want to make sure we net that out at the end.
No problem. Just real quick, if the 10 years at 3.80, 5.80 is 200 basis points above the current Fed 10-year. That's not an unusual spread, guys. So I don't think it's that big of a stretch when you're looking at a 3.8 10-year to see a 5.8 30-year mortgage. Just not a big difference. I mean, that's a pretty historic spread. We see that spread between 1.5 and 3 going back, as far back as we track things. So 2% spread, I don't think is unreasonable.
We'll make it happen, Dan. We totally agree. It's not unreasonable, and we'd love to see that. So
okay. Bonds are after turning down and gotten way bearish. So below the line is a very bearish sentiment. They're climbing back up into a bullish sentiment. Will they get kind of smacked down like they did here? I certainly don't think so. This is Goldman Sachs, and I'm not saying they're like the smartest or whatever, but if I'm going to follow somebody, it's usually going to be the lead economist for B of A, Hartnett, and Goldman has a couple pretty good guys. And this is also coming from the Fed dot plots, so it has a little bit to do with what the Feds themselves are saying, and you can see that this downward trend has begun, and it takes you down to the 3.25 level. Guys, you could see 5 if you were 250 basis points above this forecasted level. So once again, I don't think 5 is that crazy. Inflation, it's done. It is done. The Fed's going to keep talking about it. The Fed's going to worry about, are we going to get more of it? But you can see that Goldman again has lowered their inflation forecast significantly, back down in around the 2% level. And this is where we were in August, you guys. So inflation's been halved. So this is one look. I'm going to show you a more in-depth look when you talk about how fast things can happen. So this is the average trajectory of the 10-year yield before and after Fed rate cuts. So this is our current cycle. And you can see here, yeah, average trajectory before and after the first rate cut. So you can see that once they start cutting, we'll go here. It is an incredibly fast fall, and we're kind of right at that level where it really should continue to fall pretty fast. This is the average trajectory before and after the first rate cut outside the U.S. recession. If you throw a U.S. recession in, it drops much faster. And I have I'm going to show you something a little bit better in terms of the historic. So this gives you an idea of just how wrong the market is. And if you're trading stocks or own stocks, it's a good thing to realize. The blue dot is the peak of each market cycle, whether it's small or large. And the yellow triangle is the recession. So the market peaks about 3 to 6 months before the recessions hit. And a lot of people get really, really nailed not realizing this can happen. And you can see it. I think we're forming a peak here. We'll see. This is Fed funds versus GDP. So Fed funds rate, you guys know what that is. That's what the Fed talks about. And this is GDP and how high it spiked. And you can see that historically, when the Fed funds rate spikes, it takes GDP with it, and vice versa. And so now we have GDP has fallen considerably, but the Fed's fund hasn't. So this should tell you a lot. Look what happened previously when you had the GDP drop. Fed panics and they start taking their foot off the brake and putting their foot off the gas. You see this every single time going back to 1990, yet this hasn't turned down yet. It's probably about time. And I think he more or less signaled that. That's what's caused all this excitement in both stocks and bonds. This is global central bank rate cuts. We're one of the very few countries that are not cutting rates. You're seeing rate cuts around the world right now. How long for cuts after a hiking cycle? I believe he's officially announced the end of the hiking cycle. He didn't use those words, but that's really the implication, in my opinion. And so you can see in this case, he started cutting 4 months after the end of the hiking cycle, 5 months, 8, 15, 7. And so I think, again, this takes me back into that first quarter, which is 4 to 5 months, the end of the first quarter, which is like 4 to 5 months out. I think you're going to see aggressive cutting, but I think it's going to start before that. I think the next Fed meeting, I don't know the cut, but he'll signal strongly the need for cuts.
Dan, I don't want to steal where you're going at the end, but I can't help but ask, after seeing that and hearing that just based off where the 10-year is right now, there's a case to be made that we'll get into the 5s. And if you, isn't it possible that rates will get into the 4s, by mid-year based on this? Is that too optimistic to think?
No, I don't think so, because that gets your 10-year, kind of into the mid 2s. I think that's a possibility. I don't know. I don't know about year end. Well, I'll have a better feel for that when we see the next Fed meeting. But I also want to show you something. In fact, I'm going to go there right now. Because I think this is pretty meaningful. Where's my... Sorry, guys. This new monitor is making things hard for me. Desktop. I can't show the whole screen. I think this does it. Let's see. Oh, that'll work. Hey, look at that. It pulled up a commercial for you. I don't know how that got there. I really don't. All right, let's go to oh, here's Trading View. Can you see the black screen and the chart right now?
Yeah, the current cycle in the top.
No, wrong one. Let's try this again.
Yeah, we see the black,
There it is.
slide with. I'll tell you when it. Boom. Okay, I think we're seeing what you want to see now.
Okay, cool. So this is the 10-year Treasury, and I'm going to get rid of. Actually, I'm going to go to the weekly chart. And I'm going to remove everything. All right, that's pretty good. Okay, so this is the 10-year chart. And this is where we were at the end of October. And this was kind of the peak, pretty close to, I think, when you last had me on. And so we fell from 5% to 3.91, and we got as low as 3.87. How much? That's 130 basis points, guys. And it happened like that. Okay. This is not a big move by historic standards. I'm going to show you what a big move looks like. Another thing too, our members know in trading that the path up is almost always followed by a mirrored path down. So when you see these really sharp, steep moves, especially when you see these really sharp reversals, they're usually going to look about the same angle. So if you look, these are kind of the same. This angle up match this angle up. When you have a slow grinding angle up, you'll have a slow grinding angle down. And clearly we've had some doozies, but you're seeing this now. You're seeing this path down as dramatic as the path up. Talk about support and resistance. If you watch Rate Watch, you hear me talk about this stuff. So you see these little wicks? These are pivot points. So why do you call them a pivot point? Well, because the candle touched it and it pivoted. You can see this is a really important pivot point here. And we just came through it. So that tells me that this rapid decline, the next thing that will stop this is there's no support until you get down to about 3.4. So this ride down should be really fast, really fast. And this is probably mid fives for rates, right? Maybe high fives.
Yeah, can I insert just real quick some coaching notes for anyone listening to this? So, I mean, when it comes to your P&L, like it's not time to, put yourself in a position to lose money if this all doesn't happen. But when it comes to like planning for 2024, like you need to make sure that you've got the processes in place to optimize, these refis as rates come down. And for all you loan officers, if you don't have the skill of leveraging our Rate Watch app, like if you have not downloaded the Rate Watch app, get it downloaded. And if you don't have the skill of how to use that in the marketplace to create content, Denise Donahue does a great job of leveraging our app. And when there's a move and realtors need education, like she is news in Dallas, Texas, I bet there's a lot of people that tune into Denise for like, hey, what does this mean? What's it mean? So everyone, get the app downloaded if you don't have it. know how to use it. We have training every Wednesday and every Thursday. And if you're not a Mortgage Coach member and you're watching this, like, we make refis easier and faster. Like, yes, we're essential to the purchase market, but when it comes to, optimizing refis, our borrower intelligence platform has never been more valuable. And so if you're a C-suite executive watching this, make sure you know about our borrower intelligence platform and what I call the rate and term optimization loop. And if you're a loan officer, make sure that you know how to create a rate and term refi TCA fast and efficient, and that you get that app downloaded. Sorry, Dan, I just, you made the case to me that, like, hey, don't go screw up your P&L and stay lean and profitable, but get after it, lean into preparing for this. Todd, anything you want to add to that?
Well, I was going to say, this is absolutely going to be a pivotal part of the conversation you and I are going to have on Tuesday, is what do we need to do to get ready for this? And, I would say that, if you rewind the clock back to 2019, early 2020, we were having similar conversations. We didn't expect rates to do what they did, but we knew we were heading into a recession, rates were coming down. And so definitely be there on Tuesday. Dave and I will walk through both of our ideas of what we think you need to do, be ready for 5% interest rates.
Right on. I can't wait for that. Deborah, anything you want to add at this point? Or any questions you want to make sure Dan covers?
No, I think, just to echo what you said, being the media source, which is Dan Keller does a great job of this too, where he's positioned himself as, instead of going to the news channels as your outlet, become and be the advisor on media where we know the human attention is. And that's where you can leverage tools like Mortgage Coach and Rate Watch to be the expert, where it's right there at your fingertips, guys. Like, you could create a screenshot and use the green screen effect as your backdrop, or you could be like Denise and use, the lens where you switch it from front to back, where it's her and then she shows her screen where her nasty fingernails always showing, and always give her a hard time. But you have to prove in your marketing that you are the expert, and the best way to do that is with third-party data like this to validify the words that you're saying.
Yeah. And one last reminder, for all the sales boomerang customers and all the, Trust Engine borrower intelligence customers and managers listening to this, like, make sure you have, all your alerts turned on. Like, end of year is a good time to just, like, hey, am I really optimizing my database and getting all the signals that I can be? I can tell you right now, some of the most efficient and profitable mortgage companies are calling us right now, and they're reaching out to me and saying, hey, Dave, want to just do an audit, coming into the new year, want to make sure that we're getting every lead matters more than ever, every basis point matters more than ever, and every loan matters more than ever. Anyone that wants to take me up on that, just email me at dave@trustengine, and we'll audit, to make sure that you're optimizing your database. So, all right, Dan, back at it.
All right. So this was October, call it November of 18, and we were at 3.25. By August of 19, so what was that, 11 months, we were at 1.4. So this was a 200 basis point drop in what, 10, 11 months. There are moves, if I go farther back to like 2008, 9, which I may do real quick, but you see what can happen, how quickly. And then a micro dose of that, we were at about 2% December of 19, and we came all the way down to about 0.45. So this was a 160 basis point drop from December of 19 to March of 20. 4 months. 4 months. What was that again? 150 basis points. So we've already come down. What did I say? 200? No, 100, about 120. So there are drops. The point to the slide is when the Fed starts easing, things happen so unbelievably quickly. It'll just be stunned. Here's March of 2000. I know it's been way back there. We were at 6.5. by March of 01, we were at about 4.5, 200 basis points. And these just continue to happen, these straight down falls. Remember how I said the path down often mirrors the path up? You can see this manifest in many different ways. But when you see, here's a great example. When you see these parabolic rises, you're going to see these massive drops. This is back into 94. I remember that refi craze. This was, if you've been around a while, you can probably remember this. This was one of the most crazy refinance cycles that I had ever seen. And then once rates started going up, the same thing happened. They just started going up. The Fed raised rates like, was it 12 times during that period? But what I'm saying here is, just as examples, November of 94, 8.2, and December of 95, 5.3. This was 300 basis points in a year. So things will happen very quickly, and I think we may have begun that journey.
Yeah, and Dan, how many total basis points did we go up in this spike? Because this was the biggest spike and increase in interest rates in the history, right? Like we've never had a year that
No.
rates went up so much. What was the total amount that they went up?
So we went from 40 basis points to 5%. So that was a 460 basis point jump. There's one more thing.
Yeah, I mean, it gets more and more, believable that rates are going to get down into the fives and happen sooner than we think. So I like the case you're making. Of course, I like the case you're making because it'd be really good for our business and for housing. But yeah, you're making a great data-driven case. And by the way, there's a headline for everyone. Dan Rawitch, mortgage industry's top economist, makes a data-driven case for rates being at 5.875 by, into Q1, like good times ahead.
So this is Fibonacci, and just 30 seconds on Fibonacci because it's one of my favorite things ever to talk about. Fibonacci.
By the way, everybody knows that Jeremy does a really good imitation of you, and the word Fibonacci gets mentioned about 3 or 4 times.
Oh my God, we have to play that for people. That was the funniest thing ever. The words that he was making up were so unbelievable. But
I will get a little. I have a whole little Jeremy Forcier. He could be a stand-up comedian and
he could
do really well.
What he actually did was he combined Barry Habib and myself into one human.
Right. Yeah.
And then made up words the whole time.
It was hysterical.
Yeah, he's always made me laugh.
You might be able to find it real quick. I'm gonna see if I can find it while you're.
Okay, so Fibonacci. Wish I could remember what Jeremy called it. He was a very famous economist and a mathematician back in like the 1500s. I think 1500s. Fact check me on that. But he found that there were certain numbers that continually repeated themselves in many, many odd places. So the numbers, let's say the numbers of petals on a rose relative to the length of the stem always was these Fibonacci numbers. The amount of thorns on the stem relative to the length of the stem. Our nose to our mouth relative to our eyes. I just go on and on and on, leaves on a tree. And when he made this discovery, they started realizing it showed up everywhere, and they called it the golden sequence, so that these numbers were almost like mystical. And then later, when we started getting into DNA, they found that the Fibonacci numbers showed up in our DNA. So there's something strange about these numbers. And of course, some trader way back when said, hey, I'm going to apply Fibonacci to my charts. So what you're seeing here is, just real quick, this is the bottom to the top. That's what these like little light lines are. And so all I've done is I've measured the bottom to the top. So this would be like a 100, 0 to 100. The pullback here, where we are right now, is the first Fibonacci level, which is Fibonacci numbers 2, 3, and 6. And so that brought us down here. So when rates started falling, I was very clear, if you've been listening, this is where we were going to go. Very no doubt in my mind, once it began to come down, that's what happens. Look, I didn't draw that. I didn't try to make these numbers all fit, but look at how perfectly they stopped when they started coming down at the second Fibonacci level, which is 382, our Fibonacci numbers, and that takes you down to 3.30. And this is our next stop. It just is. We have this little trend line here I want to break. Depending on how you drew it, it sort of did break. But you can see, so a first level Fibonacci is always going to be 100% automatic. The catch would be if this wasn't really, we're not really top. Well, it is top because otherwise we wouldn't have come down to this Fibonacci level. Of course, it can bounce still. And then the next level Fibonacci, you can see how perfectly this line held at 3.30. So I believe this is where we're heading, and I believe this is where we're heading pretty quick. And if we can break that level, well, then we come down to 2.77. All this is, guys, is a 50% retracement. 5 is a Fibonacci number. So we've gone all the way up. We're going to pull all the way back down, and the 50% level, which is not considered a big level. We see this in trading all the time, 50% level. If it crosses 50%, then it becomes a little bit more unlikely, because after 50%, we're talking about a full-on reversal, not a retracement. Right now, it's a retracement, and I do believe it's going to get at least to the 50 level. And I can promise you it's going to get to the 38 level. So this really factors into my current belief.
I've never heard you use the word promise before.
Really?
Man, Dave, you are really pushing. You are really pushing, Mr. Tapp.
Confidence.
I
mean,
think
really,
I
I don't know that I've ever heard that before.
I think I said I promised that it might be.
That sounds more like the kind of I've heard you use before. Yeah,
I promise
there we
possible.
go. There we go. There's the chief economist, dictionary right there.
Yeah,
right.
I promise you that it might happen.
Okay, there we go.
I think that's pretty much all my slides. So we can answer some questions, and I'd love to pitch something.
Yeah, well, why don't you stop sharing your screen? And actually, Dan, I mean, dude, how many years have you been doing the daily update for, Mortgage Coach and now Trust Engine?
I remember you called me around early 2008. And I remember saying, there's sure not anything else going on in my life.
Yeah, right. That was a tough time.
So
you had to
yeah,
sell your airplane. Well, you didn't have to sell your airplane, but you decided to sell your airplane.
Yeah, no, 15 years, no, 16 years, I guess.
Yeah, so for forever, and then you've been doing a daily update for as long as I remember. Before we run out of time and people start asking questions, which, by the way, guys, start putting your questions down below. Remember, Deborah Bird, I want you to close with some social media marketing advice, but do your pitch, because I don't want people to leave and miss it, so tell us how we could get more value from you.
I'll be super quick.
Where they should follow you. Remember, he's in the Trust Engine Facebook group almost every day. He's, posting an update in a video in Rate Watch. There's a daily 2-3 minute update. And then, guys, if you really want to follow this man, Dan, tell us where they should do it, what they should do.
Okay. So first of all, the service that we were charging for, I'm now just giving out to, Trust Engine members. So if you just send a note to dan@universityofoptions.com, I'm going to add you to our weekly mailing list. And every week a weekly video comes out. So that's just free. That's just a
so wait, that's free now for everybody?
Yep.
So by the way, guys, it's not only, what's happening in the market, it's usually 10 to 20 minutes. He gives some stock, recommendations. And by the way, Dan, congrats on what an incredible year you've had in the stock market. But again, that weekly update is just huge. It's something I listen to every week.
And how do you get that?
Sorry, Deb.
How do you get that?
Send me an email, and I'm
Okay.
going to add you to our database.
What email,
We'll
just so
say
we can put it down below, Dan
Dan
at
at
what?
universityofoptions.com.
It's how I
Okay, we'll put
start
a
my
link.
week every Monday. And sometimes when I'm super excited, I watch it on Sunday night.
I do too. All
So,
right, guys, we'll
Watch
put
it
a
on
link
double
to that
speed.
down
So
below.
Dan sounds really slow today because I watch his video on double speed. Actually, I watch at 1.5 speed so I can read the charts.
I sound funny going slow. It's going normal.
Exactly.
So the end of each video, I do give 6 stock picks, and it kind of looks like this. Show you the chart, where to buy it, where to sell it, where to get out if it goes against us. And then I talk about what stock option you should buy, because it's way cheaper to buy a stock option than it is the stock. And it sounds complicated, but it's not. So this was as of the week of November 26th. We had 343 wins and 48 losses. So that's an 86.6% win rate. And that's over 105 weeks. So a little over 2 years. So total return over 2 years, 265%. And I'm now kind of giving these to you guys. So yeah, make sure you get on the list. And now I want to talk about our
And just
bots.
a reminder from Trust Engine, we do not recommend any stock picks. Buy stock
Yeah, I'm not either.
and follow Dan's advice at your own risk.
Yeah, good point.
But he is really good, and I follow it, and it's awesome stuff.
Good point. My disclaimer is always, I'm not advising you to do anything. I'm just sharing some of the things that I'm doing. You have to do your own, financial due diligence. So this was fun because my oldest daughter, Ashley, sent me this last week, showing me that her bot, we've developed these auto trading bots. Think about a robot that actually trades for you. Because the one comment I've always gotten is, Dan, I love your options trading program. It's awesome. I wish I had more time to follow it. So the bots do the work. And she started with a tiny little account. And last week she sent this to me saying she was up 204%. Yesterday, a week later, you can see from Ashley yesterday, hard to see, but she's now up 334% on her bot. So in the last maybe 2 months, she started with $500 and now the balance is $2,300. That's a lot of money for a young person. So that's pretty cool. And then this is our newest bot. And you can see that for the last 372 days.
We're not seeing your screen, Dan, if you're showing us the bots.
Oh, man.
Yeah, I was
Sorry.
just getting ready to say, are you showing your screen? Because
Dan, you guys just
Or you
installed
just-
a bot. You just installed a
But
bot
by
this
the way,
morning for me, and it's already up 1% since you guys installed it this morning.
so you're
that's-
using bots, Todd? You're using Dan's bots?
I'm using the bots. I've had them maybe for a month, I think, right? So, I'm not up 300%, but 91.77, 8.69, 62.04.
Man,
I hope you guys have this in the first home IQ stuff. Teach some of these youngins how to do this.
Well, it's just writing Dan a check. That's how you're getting it on this. It's not teaching
Can
them
you see my
anything.
screen now?
Yeah,
Yeah, we can see it now.
Okay. So back, Ashley, 200% last week. Ashley yesterday, 334%. She grew the balance. She started with 500 and now she's up at 2,300. So that's kind of fun to see. Our newest bot now is our stable bot. It's called Stable FX. Over 372 days, it's averaged 48% a month. These numbers are unbelievable. But they're true. This one, the USD CAD bot is over 370. Oops, same one, sorry. I duplicated that slide. Here's another look at it, 297% since November of 22. And then the last thing I want to say is what you see here is me trading someone else's money. So there's been this huge upsurge in these companies called prop firms. And what they do is they say, if you can pass my challenge, then I'll give you capital to trade, and I'll take 20%, you keep 80%. And we just passed our 50th challenge in a row without any fail. Nobody has failed using one of our bots. The tricky part, just to be totally upfront, is you can fail after they give you the money. So I cannot lose more than $30,000 while now that I'm funded. And you can see, of course, I'm up about 7,000, and that's in 18 days. And you can't have a daily drawdown. In any one day, I can't lose 10,000. If either one of these things happen, the challenge is breached and you got to start over. That's okay with me. If I can make 7,000 for the next 2 months and then I blow up, to take the challenge was $800. So it's not a lot of money. And I could submit right now for $7,000 profit on something I paid 800 to get. So I'm literally trading with $200,000 of somebody else's money. It's a pretty cool concept. And like I said, we have the bot to help you pass the challenge. All right, that's it. So if you want to know more,
again, I'm getting on the bot challenge. That's my next thing. So just be looking for a reach out from me to the team. I'm in.
Yeah, just email or you're on Telegram, right, with us?
I am.
Okay, yeah, just reach out to Marianne and she'll get you all the particulars.
All right. I'm going to reach out to her right now. So we've already been chatting this morning. So
Dan, where should folks go to, learn more about this, and I do want to get some of Deborah's social media advice. So, what should they do to learn more and get on your program?
Dan at universityofoptions.com. I'll forward it to somebody in our sales team. So it could be one of 5 people that get back to you, and they're all mortgage people that work on our sales team.
Awesome. We'll go ahead and stop sharing. Congratulations, Dan, on just what an incredible job you've done of building your options trading community. My son has been through your options training and loves it and has done really well with it. Actually, I think I told you, Dan, Sid reached out a couple weeks ago and wants to go through your training. So it's really good stuff, guys, and it will make you a better. Like, this whole call and my whole belief is to make loan officers better and to turn loan officers into data-driven mortgage advisors. And part of the data-driven, it's understanding markets. It's understanding how the data in the markets impact the real world. So hopefully you guys, you got smarter from the inside out. And then it's like, hey, using data to present better, using data to be the news in your market. So Deborah, what did you take from this? What advice do you have for loan officers to take this data and win? And Todd, you got to go later, bro.
I got to go. Thanks, Dan.
So
see you Tuesday, man.
I broke it down into 4 different segments. So the first one would be for current shoppers, like if you like a sense of urgency, that I think it was Black Knight that said for every percent that interest rates drop, it opens up 5 million more potential buyers who can qualify. So one, getting a sense of urgency for anyone who's currently shopping of what's to come potentially by the end of Q1. So that was
get them
compartment
locked
number
and
1.
loaded. Get them locked and
Yes.
loaded. Reach out, take pre-apps, go.
Compartment number 2 is protecting and bulletproofing your current mortgages under management. So, even if it's not maybe the perfect time for them to refinance now, they're going to be hearing about it. Servicers are going to be attacking them. So what is your systematic and proactive way of being that vessel and resource of the news and letting them know, like, hey, this is why you guys hired me, even if we closed 2 years ago. So let's schedule your mortgage checkup. So annual mortgage review, January. That could even be an educational class to your clients. So I'd recommend to all of our clients that you do at least one Zoom webinar for your current mortgages under management every month, as well as your agent partners. And this would be a great topic to do for both next month. The third compartment was fence sitters. So having messaging out there, like some examples could be falling mortgage rates signal a prime time for home buyers. Expert Dan Rawitch predicts mortgage rates to plunge to 5% by end of Q1. For the
5.875. He did not say 5%. He said in the 5s. And I would
Okay,
put an
in the
exact
fives.
number in.
In the fives.
And I like exact number, 5.875.
5.99, please.
And then I would use a
Economist.
TCA to show, to hit on, for education. The last segment was for your real estate agent. So helping them with conversion with current fence sitters, or for the home affordability challenge of, using the TCA to show here's what your purchasing power was today. Here's how you can buy more home when rates drop to the 5.875. Or if you don't want the bigger home, but you're trying to stay within a monthly payment, then, showing them those options with the TCA.
Boom, guys, it's been a great call. So if you are not, if you're at a company and they do not have their database monitored with Trust Engine, guys, you need to. I just can't emphasize enough how many loans are at stake if you're not monitoring it. So make sure your C-suite knows about Borrower Intelligence Platform. That is enterprise only. Sorry for any individual loan officers that are tuned into this. Turning data into dollars is, it takes a lot of folks to do it. And so, but do get a demo. For all you mortgage coaches, get signed up. You go to our website. Deborah is top social media consultant in the mortgage industry. Deborah, where can they go to learn more about, your services and get help?
So you can schedule a free discovery call directly from our website, which it is me that does that call. So just go to plugandplaysm.com.
So, and Dan at universityoptions.com, links down below. Dan, any closing thoughts before we wrap it up, or, anything else you want to say?
So I've gotten a couple private questions. If I could just share one slide real quick, not a slide, but something in real time. We'll just take 1 second here.
Yeah, no problem.
I think it's important.
I don't get you that often. And when I have you here, and I'd love to catch up on a bro level. Let me know if you have any few minutes over the weekend.
Yeah, I'd love to. It's been too long. Can you see my chart?
We can.
This is the spread between 30-year mortgage rates and the 10-year bond. So you can see we have two issues with rates, and the bigger issue is quite possibly the spread. You can see the spread before all things kind of went to hell after COVID. The spread between the 10-year and mortgage rates was less than 1.5. So if you take 1.5% spread to the current yield of 3.9, you have 5.4% rate. If you take the current 3% to the current 3.8, then you have what, 6.8. So this needs to come down, as well as the 10-year coming down. And the 10-year coming down will actually bring this down. What this is telling you is that there's concern about mortgage credit quality. Investors maybe think mortgages aren't as liquid. And typically, if you see the economy get better and you see more certainty in the economy, that's what will bring this down. So this is higher than I've ever seen it. We're going back here, what, 30 years? And you can see it's usually run sometimes as low as 1, but 1.5 to 2 is a very good number. And of course, it's going to come back to that level. There's no reason that it won't. So one of the things that make rates come down so fast is you get this double whammy. You get the 10-year coming down, then you get the spread coming down. And so things happen twice as fast. Yeah.
Dan, that was a great clarifying micro lesson. Dude, I am super grateful for you, everyone. This is a wrap. Hope you got a lot of value today. Take care, everybody. Have a
Thanks,
wonderful
guys.
week.
See ya.